Welcome, everyone. We are so pleased to have you here joining us today at our 9th session of Gallagher Talks. This session topic is using surety products to improve your balance sheet. Our speakers will be engaging in discussion on how we can protect our balance sheets with creative solutions to free up cash and improve liquidity. They'll explore in-depth underwriting in managing Canadian cross-border and international surety requirements. I'm pleased to introduce you to our speakers today, Tyler Averill, our SVP of National Sales, and Rob Dempsey, our Senior Vice President, Commercial Insurance. Both Rob and Tyler are coming to us live today from London, Ontario. If you would like further information on Rob or Tyler, you can click to the side of your screen there and connect with them directly on LinkedIn. Just a couple of items before we get started. You'll be receiving a recording of this webinar later this week. And because of the fast-paced nature of our talks today, any questions sent in via the Q&A box will be addressed later this week. For anyone on the line having connectivity issues or sound issues, please reach out during the session using the Q&A box, and we will be here to reply and troubleshoot with you. We hope you enjoy today's topic. Remember, if you are on LinkedIn or Twitter, please share about your experience today using the hashtag Gallagher Talks. I also want to mention that we have 2 more sessions following this one, should you wish to join us. We'll be talking about energy and captives. Just follow the link that will pop up on the screen after Tyler and Rob's presentation, and it will take you to the next session. Without further delay, I will now turn it over to Rob and Tyler.
Thank you, Kelly. Very excited to be here. I'm kind of a surety nerd, so I love talking surety, and happy to address any questions you may have. Some of you may or may not be familiar with the surety world, so let me start with a little bit of a surety 101 talk. Most people are familiar with bonds that are what's called contract bonds, and they are when a contractor puts in a bid to a municipality or province, and they also have to submit a bond with it, within the surety saying they will complete the contract as they bid, as they put in that price. So that's the common understanding most people have with bonds. What we are actually talking about is a newer, more of a developing area of surety, and that's called commercial surety. And it's more of an on-demand payment bond structure. And really, it's meant to replace restricted cash, letters of credit, and that's primarily what Tyler and I are going to be talking about today. Within a bond, there's 3 parties. So excuse my, talking a little bit more about surety. There's 3 parties to a bond. There's the obligee, which is the recipient of that obligation. There's the principal. So in other words, the organization that purchases the bond, that has that obligation to the owner or the obligee. And then there's the surety, the insurance company that comes in behind and backs them, saying that they will complete that obligation. So Tyler, what would you like to talk about today?
Well, I think the first thing that would be worthwhile diving into in dealing with several clients that I've kind of interacted with from time to time when bonding or collateral requirements come up is the question always arises whether the owner will look at the bond the same way they look at a letter of credit, and whether they think the bond is as liquid as a letter of credit. So maybe you can start off by just addressing for everybody on the phone the liquidity of a bond versus the letter of credit and what that means.
And that is always a little bit of a hurdle in the commercial surety world, but it is every bit as liquid. The trigger to call the bond or LOC is essentially the same. The terms or period of payment, again, is the same, is meant to duplicate what a letter of credit. Really what a bond has a number of advantages. It provides a broader protection to that owner. The wording is, as I say, quite similar. The advantages to the organization, the principal, is it is actually an unsecured bond. In other words, it's not tying up your banking facility. There's not usually collateral needed. The surety is not collecting a letter of credit. The indemnities do not change. the pricing or cost of a bond is usually around the same cost as a letter of credit. It depends on the scenarios, but I guess I would say in many cases, the bond is actually a lower cost. First and foremost, the main reason for the benefit of a bond is it maximizes the principal, the organization's working capital by actually reducing the capital restrained by the LOC posting requirements. So that frees up that cash that you have tied up through the LOC, your banking facility, and now you are likely making the same sort of return on investment, the ROI, that your organization would require, pursue 10, 12, 15%, whatever the case, versus some LOC costs are 1.5%. So instead of an expense ratio, it improves your overall return on equity.
Yeah. You mentioned that the bonding is as liquid as a letter of credit, which is great. And I know they can customize the wordings to kind of make them comparable, and that the cost can be comparable at the same time. So these bonding or surety companies that are taking on this risk, they have to be looking for different underwriting criteria. Maybe can you talk a little bit about the underwriting criteria and the process that takes place so bonding companies can get the comfort with that particular company and provide that bond?
Yeah, sure. I work, myself and Jamie Nichols are the leaders of our surety practice, our commercial surety practice. So we deal with this quite a bit. And the submission we need to collect to send to the surety companies is critical to be able to get the terms that we're looking for. And there's a wide array of information we need and have to thoroughly understand. The obligation to the owner or to the obligee in our surety world is the critical thing for us to be able to understand. Usually it goes hand in hand with the contract terms, because that is what the bond will be ensuring, will be the contract itself. So we need to understand those. Sometimes it actually needs an amendment where they will accept a bond instead of a letter of credit as a form of collateral. Then what are the other considerations? The size of the bond can be a factor in how much underwriting the surety wants to go through. We've got into 100 millions of bonds and even in a situation where it can be up to $1 billion. So we've looked at some large obligations on behalf of our clients and come up with some pretty unique solutions. Duration of the bond. The contract can have several years involved, and specifically the ones that tends to have the longest tail can be a reclamation or a mining situation where the life of mine can be up to 25 years. So the surety's looking at a relationship in which they have to project the cash flow of the organization for a long period of time. Again, so that will be part of a consideration. The credit rating of the organization, including, of course, the strength of the balance sheet, is critical. And we work very close with your organization to be able to understand. Next, and this is a kind of unique one and constantly flowing, is the industry risk. Give you an example where cannabis was the hot thing, and probably 3 or 4 years ago, it was the hot item for investment. Banking facilities were happy to invest in. Now, today, unfortunately, it does not go quite as projected. The financing relationship is a little different for cannabis, but it also kind of applies to bond. Unless you are investment grade, it's difficult to get a cannabis bond. But on the other hand, in the mining industry 10 plus years ago, to get a reclamation bond, especially outside of Canada, was it wasn't impossible, but unless you were investment grade, it was very, very difficult. Whereas most sureties are quite interested in doing reclamation. In fact, some specialize in junior mines. So not even an operating mine, but just with that future reclamation obligation. So the industry can be a big factor on what sort of capital the surety is willing to put forth. Then political environmental. We get involved in bonding situations throughout the world. And obviously there's some political turmoil going in different countries. Luckily, in Canada, we're not seeing that. But they have to underwrite that and potentially the environmental risks associated with different countries as well. The bonding wording required. So that is where I think where our team excels in that understanding of what the obligation your bond will create for you, the principal, or for the owner itself. So we go into a lot of detail and understanding not only the contract, but actually the bonding the wording we're willing to provide.
That's great. And I know that the bonding team really does some pre-underwriting on files ahead of time to make sure that they prepare that file even for a surety or a carrier to look at the risk, and even in general, kind of analyzing all of this data and the financials and the financial strength of that company, and even just how that company operates, right?
Yes, we do. We have to. I'd say I guess we have a fair bit of respect from the surety industry in that regard, but we have to do our homework ahead of time, as you say, getting to know the organization. But to be able to give that proper submission, that comfort level to the surety company is critical.
That's great. So it sounds like there's been a ton of innovation in the space, and I know that I've worked with you guys with some clients where we've kind of put solutions in place for the first time. Maybe you can talk about the types of products or sectors that maybe have been impacted by this innovation, and maybe some areas where people may not even be thinking it may apply.
Okay, yeah. So I prepared some examples of where commercial surety will provide bonds. But I guess my main point is this list is growing and growing. We're learning a lot of new areas, or industries are learning an area which they can spread out the risk to use of a bond. My main point, however, is with this financial times, I would say, our economic uncertainty, use of bonds is critical. I would strongly encourage it to de-risk your organization. So different areas. Reclamation, it would be one of the key areas of commercial surety bonds. And those are throughout the world. Certainly Canada is a mining leader, but as we grow, and there's many opportunities in South America as well, we've worked on some unique deals there. Subdivision bonds. Many people are familiar with the Tarion bonds. Subdivision is a subsector or another section of those. It's a situation where a developer is making new subdivision, and the local municipality typically will want a letter of credit. We have a growing trend that more municipalities are now willing to accept a bond as a different form of collateral. That has changed the world dramatically for the developers in those areas, because it allows them, it of course frees up cash and probably doubles their capacity as a result. The advantage to the municipality, more work getting done and in a more efficient manner. So that's been fantastic for our industry now that municipalities are allowing for subdivision bonds. Lease guarantees, another growing area. Many of the larger landlords are apprehensive about giving their prime real estate, their prime properties, to a startup, a growing or small organization. So when they build into the lease, typically what they ask for is a letter of credit to make sure that they can complete those lease obligations. We have been using bonds to release those letters of credit, again, helping these startup organizations. Customs. We work with some of the largest online shopping websites, and who therefore have a large customs obligations on both sides of the border. And so therefore, the use of bonds versus a LOC for the customs side of maybe Canada or US has helped free up a lot of their cash as they are going through quite a growth phase as well. So Tyler, I'm going to go into a little more detail on this next one, supplier customer guarantees. This is the area that most people aren't even aware of what can be used and how this could potentially help their organization. We had a client who was growing very quickly with the supplier. The supplier was getting a little concerned with the amount of receivables, the line of credit they essentially were having to run with this organization. Whereas the customer, growing so quickly, it was creating a fair bit of cash flow issues on their part. The customer was looking for a 10-day to a 30-day credit system, payment term. And the supplier, along the same lines, didn't want to extend further. What we did, we put in the bond for approximately about half of that line of credit, allowing them to go from 10 to 30 days. That provides the supplier, of course, the security on that receivable. But the biggest benefit to both sides, is that the sales now have tripled between those organizations. So it's been a win-win. The customer themselves have saved well over $1 million in interest costs because not having to use their own line of credit to be able to finance that growth. So anyways, I would strongly encourage whether you're the supplier or the customer, there's some great opportunities there to introduce a third party's balance sheet, bring in an A-rated surety company to ensure they will meet those obligations. Workers' compensation, not so much of an issue in Canada, but in the U.S., the individual states require a LOC, or in some cases a bond for the workers' compensation obligations they have outstanding. Next one, and this will be growing as well. We're in an insurance hard market, which probably most of you know. So many organizations are looking to increase their retention, maybe set up on captive. So whatever the case, you now have a larger retention. An insurer is concerned, do you have the ability to pay your deductible? So they ask for collateral, and we've been able to put bonds in place instead of using up your LOC, your banking facility. An appeal bond, you get into disputes with the CRA, and you don't think you owe the taxes that they are saying you do. In the courts, they will ask for you to put up an appeal bond as you go through that process. And the next one, Tyler, is actually kind of an exciting one. Within the pension area, there's a subsection called SERPs, which is a supplemental executive retirement plan, almost like a pension plan, enhancing for the senior officers of a company. So it's a form of a deferred payment plan or pension. It's obviously can grow to a pretty large liability within your balance sheet. And your employees are concerned, are you, the organization, going to have the ability to pay once I'm in that retirement stage? So the way you can put so let me go back. So within the balance sheet, it's not always fully funded as a reserve. Many times they rely on their cash flow of the future to be able to pay that future obligation. So to help your employees sleep at night, a bond can be put in place that essentially guarantees that obligation. Again, brings in a surety company to help. Many other opportunities we've talked, so maybe lien bonds. I can talk about lien bond. We put in one of those recently, helped a client of ours that had a contractor who really didn't, I won't get into that, contractor who's disputing why they weren't getting paid, to release that lien. Our organization can put up a lien bond, and then you go through the dispute in the courts, so it doesn't encumber your property. Many other examples, and happy to go through them with anyone as we come across them. Yeah,
for sure. I know that there's been a lot of innovation in the space, and I think one important point to make at this point is that if there's a situation where there's collateral acquired, or you currently have restricted cash in the balance sheet, and you know that the owner won't accept a bond, or it's not in the collateral requirement descriptions. Often it states that there has to be cash or letter of credit there. We have worked in several cases with owners to go back and forth and negotiate a bond as an acceptable form of collateral, where it previously hadn't been accepted in the past. And I think that's a really important point to note.
True. Maybe that leads us into so that is the benefit of, I guess, working with surety experts on any sort of a bond obligation, but specifically within the commercial space as well. So you're right. There is, that would be one of the larger hurdles as getting owners to accept a bond. Sorry, am I getting a little feedback there? So owners to accept a bond. But I guess there's more knowledge there, and we've had some success in showing why there's quite a benefit to use of a bond over that. But the other thing I guess I will mention is that sometimes it's just not happening. The government or the regulatory bodies is simply just not willing to accept the bond. We can work with your banking facility, who will be putting up your LOC, to backstop that letters of credit. So in other words, it doesn't encumber that cash. So the obligee in that case would be the bank. You can't enhance your credit, but it is a way in which you can free up some cash. So continue, and I guess along the slide before we go to the next one, we do work with organizations all over the world. But I also would say we are the surety experts. We work with our practice leaders throughout the world, really, be it transportation, realty, manufacturing, you name it. And so they come across these sort of scenarios where it's restricted cash, or can we come up with better terms for the bonding? And that's when they engage us, and that's usually been to quite a successful relationship for all parties.
Yeah, that's good.
When it comes to, so I'm answering your question, I guess, in the long form here, Tyler. But so back to, why would an owner want to accept a bond? Everyone's familiar with the letters of credit and the terms and the speed in which you get paid. Well, there's a large list of benefits, and usually we're able to convince them of it. The main one being is it's an extra level of underwriting analysis of the organization to make sure they are even financially capable or have the history of being able to perform this type of obligation. In other words, it puts their interest right in line with your own. The surety company does that extra level of due diligence, and probably that your organization is able to do, or have the information to be able to do. It encourages the growth of those key clients. I go back to that recent example in which they tripled their sales with that organization as a result. I would also say, and I don't have it specifically as a point here, it's a competitive advantage to you potentially as an owner or supplier compared to some of your competitors. If you are not, if you're able to expand your interest beyond an LOC and use a bond, that helps your clients, or it helps your competitive advantage to make you more appealing of a supplier to work with.
Yeah.
Bond wording is just as liquid as I've said many times. And it's a new method of gaining collateral while not suppressing the growth of your organization. First and foremost, though, the main thing here is we're protecting your business. So, the bond protects the business. You now have introduced a third-party balance sheet, the surety, and it protects your stakeholders. So it de-risks that obligation that you have with this third-party organization.
I think that's an important point. One of the key benefits I've seen for owners is that when you request a letter of credit, almost any company can produce that letter of credit, without question. There's no process really required to get that letter of credit in hand. It's just a kind of a banking transaction. In order to get a bond, that bond has to be underwritten, and there has to be due diligence put into the underwriting of the financial strength of that company. So as an owner, when you're deciding to ask for a bond versus a letter of credit, you're actually asking for an extra level of scrutiny over and above what traditionally would be provided, with the same collateral backing. that you would normally receive, which I think is really, really critical distinction to make, because it actually improves the quality of supplier or service provider that you would be dealing with.
Yes, you're absolutely right. It's not, sureties are all well-funded companies. So, if you're concerned about an LOC being less risk than a bond, well, we're happy to show the financial stability of all the surety partners we work with. So it is easily just as I say, just the same or as liquid.
Yeah, I think one last point that's really important to make too is, like we mentioned earlier, there have been processes where we've worked hand in hand with people and clients to meet the collateral requirements with the owner. So there's sometimes a back and forth process, but that process is possible. We can negotiate on it. And the other concern I often hear is, well, we have more than enough money. It's not a problem. We're strong financially. And what I would say is that's exactly the time to get your bonding, your relationships set up, because it's much easier to get bonding at an affordable rate and a competitive price and great terms when your financial strength is there, versus, God forbid anything were to happen that would impact the financial strength of your company. But if that did happen, it'd be much harder to get that approval or the rating required on that bond, and as a result, free up that important cash. So, if you have that cash sitting kind of restricted and tied up, now's the time to take a look at it, right?
Yeah, be ready to act. That's true. And so I talked about the economic uncertainty we're in. I think there's going to be some great merger acquisition opportunities for the organizations that are well-heeled, that feel that they don't, they have all the capacity they need through their financial institutions. Well, introducing a bond company is potentially going to allow you to act quickly when the opportunity comes about. And as I say, it does actually lower the cost likely.
Yeah, for sure. Any closing comments, Rob, that you kind of want to think of making here?
I've talked for a bit. I guess the main one is we're happy to work with anyone and look at any sort of opportunities that do come about. I think we're going to see some financial restrictions coming from our financial institutions. So the commercial bonds will be quite a growing field. So keep us in mind for any situations you may encounter.
Perfect. Well, listen, Rob, we really appreciate you taking the time to share your knowledge and impart your wisdom on us regarding bonding and surety. And for everybody on the line, we really appreciate attending this session. And if you have questions, feel free to reach out to us. We'd be happy to help. Have a great day.
Thanks, Andrew. Goodbye.
Bye.